talking about Walmart, some of the other major retailers. Michael, let's start with Walmart and sort of how you think about today's quarter and what it says for the story for what's been a big pandemic winter. They've really broadened that strategy, including more e-commerce, and I think given a pretty optimistic outlook on where they see the economy and the consumer headed this year.
Right, sure. Certainly an unbelievably strong result. We actually increased our same-store sales estimate following last Friday's really strong retail sales number, and we're ahead of consensus, but didn't increase enough. We saw an acceleration on a two-year stack basis, which is an important metric that we look at. I think really, though, the story of the quarter is the gross margin gain, up about 100 basis points, really stronger than we've seen it in decades. And I think that's a combination of the mix more towards general merchandise, which has been a very positive trend, but also some of the things that they're doing with some of their alternative e-commerce businesses, things like advertising or their third-party platform, which is starting to pay off. And that gives them the ability to invest back in price in other areas.
On that point, though, I mean, we keep hearing everywhere the input prices are going up. So is it just that they offset it by these other things that you're talking about, or were they also expanding margins by raising prices?
Well, in fact, they're lowering prices. So it's really the first thing. Through some of these, the mix to general merchandise, which is higher margin, as well as things like their Walmart fulfillment services, their advertising business, which they call Walmart Connect, their third-party platform on Walmart.com, all give them higher margins that they can invest back in price. Even within the food business, the mix was positive towards things like fresh produce, meat, et cetera, which are generally higher margin categories than some of the dry goods that were primarily sold or were the big drivers of last year's first quarter growth. So they've been actually able to roll back 30% more prices this year than they did a year ago, yet still drive higher margins to offset some of the inflationary and supply chain pressures that you mentioned because of the strength in those other areas.
Michael, I have a tweet going viral right now, and that tweet effectively just showed how much lumber or plywood inflation Home Depot saw in the most recent quarter. Year over year, it was up 4 times. How concerned are you about that type of inflation sustaining itself for Home Depot this year and ultimately impacting the company's volume?
Well, it won't sustain. It actually keeps going up and up every week, but eventually it will slow down. It is sort of an unprecedented environment. Right now, though, they're not really seeing any impact in unit demand. In other words, anything that they can get in the stores, even at the elevated pricing, is sold. There's a little bit of a bottleneck in the supply chain there in terms of getting all the lumber that they need. But when they get in the stores, people are buying it. There's a huge demand for it. It will flatten out a little bit. We assume at some point this year, because, again, this is unprecedented. So we just believe that eventually it'll revert back to the norm. But again, units have been strong. If it does revert back, what you'll see is that it'll take a little bit of wind out of the sail in terms of the same sort of sales, but will help margins because lumber is a lower margin business. So as that's increasing in the mix, because of the inflation, it actually hurts the overall company gross margin. But let's consider this. Inflation did help probably in the 300 to 400 basis point area in terms of the comp, but the comp's up 30%. So there's a lot more going on here than just the impact of lumber inflation.
And Mike, kind of a general question about both these names, Walmart, Home Depot, huge flagship American brands. Everybody knows them. Pretty much everybody goes into one of these stores. As an analyst looking at companies that are this large with this big of a tailwind, I mean, a 30% comp at a business the size of Home Depot is kind of outrageous. How do you view the story going forward? Like, how do you start to talk investors through this idea that you're going to see a huge slowdown in comps, and yet this is still a best-in-class retailer in a large and growing category?
Yeah, we will see a slowdown. I will say that this kind of 30% increase, although it was our model, which again we updated last week for Walmart as well, it really is unprecedented. We don't think it'll continue. The way we're looking at things is really versus 2019. And I think what we'll see for a lot of these big box retailers is you will see growth relative to 2019. And so what that will tell us is that some of the business that was picked up during the pandemic is sustainable. They're not going to give it all back. It won't grow as much, but they are certainly all, or not all, but many of these big retailers have taken market share and it will be sustainable, not to the same growth level, but certainly more than it was a couple of years ago in 2019. A lot of it is driven by stimulus, certainly. That will slow. On the other hand, consider that the savings rate right now in the U.S., at least as of the first quarter preliminary GDP report, was north of 20%. We think that will unwind a little bit, and that'll offset the lack of stimulus and help support the sales strength going forward, we think. But again, not at the same level. The appropriate way to look at it is really on a 2-year basis versus 2019.